Hey everyone, Roger Herring here. I am the investor's accountant. Welcome to another edition of Ask Roger. This is where you get to ask me a question about wealth building, about real estate investment, about taxes relating to any and all of the above, about operating in tax-free environments. All the things we love to talk about here on this channel. And hey, if you're new to us or maybe you're old, if you look down below, you're going to see a link. And if you'll follow that link and fill out a simple little 3-line form, I'm going to give you a free gift. That free gift is a PDF that has some of my basic tax strategies that apply across the board to all small business. Very handy little item, might give you some ideas you hadn't thought about before. Just click that link. So, today, Leslie wants to know, I've heard you talk about leverage. I've heard you talk about multipliers. Exactly what do they do? Okay, Leslie, let me break this out for you, okay? Leverage is a form of a multiplier. What is a multiplier? That's the first question. Well, the strict definition says it's an economic factor that, when applied, amplifies the effect of some other outcome. So, using leverage is a multiplier. And there are different types of leverage that we can use. The one most common, and the one that I'm going to show you the example of today, is other people's money. Now, what do we use leverage for? We use it to blow up cash flow and blow up profit. So, other people's money is one, definitely. But there's also other people's time, using your employees and using contractors, so you don't have to do everything yourself. Other people's resources, you need contacts, you need somebody's Rolodex. That's OPR. Then there's OPC. If your credit is not good, you need credit, you partner with someone that's got good credit, you're borrowing their credit. And last, other people's money. The most commonly used, or actually the most commonly known form of leverage that there is. So let's switch over to the whiteboard and walk through a couple of examples, okay? Okay, guys, here we go. Now, first off, let me just say there is absolutely nothing wrong with not using leverage in real estate if you've got enough of your own money. And if your goal, let's say that you're a landlord and you just want a couple of cash flowing properties to provide income, absolutely nothing wrong. Leverage would be used if you want to build a portfolio, because the whole idea of leverage is to control multiple properties with as little of your own money as humanly possible. So let's just look at a couple of examples here. All right. Let's say that you had $100,000. You got 100K. And you could go out and you could buy one property. And let's say that that property is bringing in rents of $10,000 a month. Okay, that's your rent. Now, you also are going to have holding cost, HC. And let's just say that they were about $2,000 a month. That's going to give you a positive cash flow of $8,000. That's a heck of a lot more than you'll ever make at the bank. That's really good. But let's say that you wanted to build a portfolio of rental properties. What could you do then? Well, instead of doing this, you still got the same $100,000. What if instead of 100K down, you bought one property and you put down 20,000 and you finance the other 80? Now, you've still got rents coming in at $10,000 a month, or excuse me, per year. And you still got holding costs of $2,000. So that's still $8,000. But what do you have now? Now you have debt service. And let's just say that's $5,000 a month. Well, that cuts my cash flow down to $3,000, Roger. Why do I want to do that? Here's the deal. You've only spent 20 of your 100,000. That means you can do this 5 times. So now your cash flow off that same $100,000 is $15,000. Well, Roger, what about all that interest?
that interest is already included in here, and that interest is deductible as a legitimate business expense for that rental property. So the example here shows leverage as a multiplier. We are using a principle of leverage, meaning other people's money, to control 5 properties instead of 1. And we are gaining, by doing this, $7,000 extra in cash flow. 15,000 down here, that's 15K minus 8 gives us our $7,000. So this is something for you to consider. You want to use a small amount of your money to control as much real estate as you can and blow up the cash flow.
All right, gang, that is absolutely it for the day. I hope you have learned something. Remember, click that link down below, and I've got a free gift for you. Until the next time, Roger out.